This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today, we've packed a number of shows together to give you some highlights. I know you're going to enjoy the show. Thank you for being with us today.
Our guest is Ted Lanzaro. Thanks for being on the show again, Ted.
Oh, thank you, Whitney, for having me. I really appreciate it.
I know a lot of investors that are listening and are wondering, how do we do this? What does that mean? Is this something I should do? This 1031 lingo that we hear all the time, right? And so, let's get started as far as, maybe you give us just some brief background of what this is and then let's dive into some details.
Okay. Yeah, sounds good. I mean, it really is one of the available strategies when you sell an investment property. It's one of the available strategies to defer the capital gains on the sale of the property. It's probably, in my mind, the most important wealth building strategy in real estate investing. And here's why. Let me give you an example. So I had a client, he was a plumber, okay? And as a plumber, he would go out and he would do his business, but he also started picking up small residential units, a 2-family here, a 4-family there, a small apartment building. And over a period of about 8 years, he built up a portfolio of about 150 units, right, that he was running and managing locally. Now, this was at a time, this was in South Florida, and this was at a time when the market was beginning to rise. Prices were starting to go up. And so what he did was he actually sold his entire portfolio to another investor. And he would have had about $1 million capital gain on the sale of all of those properties. And so what he did was he decided, well, I'm going to do a 1031 exchange. And he went and he bought a shopping center on the main road in Boca Raton, Florida, where I live, and used that shopping center as his replacement property. So he never paid tax on the $1 million. He just did this 1031 exchange and bought a replacement property for actually more than what he sold the whole portfolio for. Okay. So now over the next year and a half, he's fixing up this shopping center and he's putting new tenants into it, right? And the market's continuing to rise at this point also. So it's at one point when he's complete, he's got it fully rented, he gets an offer for it, which is $2 million more than he paid for it. So now he's got basically a $3 million capital gain. And so he's like, well, what do I do now? I'm gonna do another 1031 exchange. And so he took the proceeds from the shopping center and he ended up investing them passively into 6 AutoZone buildings in Texas, and which cost him a little bit more than what he had sold his shopping center for. But he's completely passive. It's a triple net lease, so AutoZone's paying all the expenses on the buildings. He has a management company who basically collects the rent, writes the mortgage check, and sends him the balance. And at that point, he's making about $40,000 a month, totally passive, and now he's retired, right? And so he's never paid. He's up now like $3 million in capital gains. It hasn't paid a cent in capital gains tax because he's been using the 1031 exchange to defer these capital gains. So you can see how that's like over the course of about 5 years, his net worth went up by $3 or $4 million, but he never paid a dime in taxes. And that's why I say it's a very important wealth building strategy.
Wow. I was going to ask you about how long that took, but you said about 5 years, and that's
about 5 years.
Very impressive. Do you think that was the timing of the market of when he got in, or do you think that most people could do that in, say, 4 to 6 years?
I think a lot of it had to do with the timing of the market, right? So it's a great strategy when you're picking up things at the bottom and then selling them as the market rises. Okay. Now, did he pay a premium for the properties he bought in Texas, at the end of the AutoZones? Yeah, because he was at the height of the market at that point, but he was also deferring gain, and he knew he was getting into a kind of a low return kind of scenario, but he had already deferred all of this gain. So, and it was triple net, it was easy, it was passive. So he didn't have to do anything else but collect his money every month.
Wow. 5 years of retirement right there. That's awesome.
Yeah.
So what are some basic rules, some basic things we need to understand if we're looking at, this same scenario or being able to do a 1031 from one deal to the next and growing our portfolio that way?
Okay, so the way it works is that when you sell a property, all of the proceeds of that property go sort of into escrow with what is called a qualified intermediary. It's somebody who facilitates 1031 exchanges. At that point, you have 45 days to identify properties. You can either identify up to 3 properties of any market value, or you can identify more than 3 properties, but they can't be more than double what the value of the property you're selling is. At that point, after you've done your identification, you then have a total of 180 days to close on those one or more of those properties. From a practical and investor standpoint, right, you don't start looking for the properties, the day of the closing of the property you're selling. I mean, you're selling a property. There's typically, from the time you sell the contract until the time you do get through the seller or the buyer gets through their due diligence, right? There's, there might be 3 months there. There's, 9 days. So you should be looking at a property, that whole time, right? So that you're actually adding to the clock by looking for replacement properties before the 45-day window ever even starts, which is the day you close on the sale. So what could people be doing like now where the market's a little tighter or whatever, right? Let's say I have a property that I might be willing to exchange, or let's say I come across a great property right now, right? So I know that I can put my other property on the market and probably sell it pretty fast in this market. There's a huge demand for rental properties right now. So let's say I find a property that I know has a better rate of return than something I currently own, right? Well, now I can actually just say, okay, look, I'm going to buy this property. And now I even start that process. And then I put my other property on the market, with the idea that I could probably, they might even end up exchanging simultaneously, right?
So you began the process of buying the second property before selling the first one?
I could if I wanted to, right? Because I've identified this property. Maybe I just put a contract on it, knowing that I could sell. I mean, this is from an investor standpoint, right? Knowing that I can sell my existing property. Correspondingly, right? If I've got a property that I'm making, that I bought 10 years ago and I'm making 10% on it, I need to be able to find a better property in this market. And that's why a lot of 1031 exchanges, at least right now, don't happen, because it's very difficult to find a better replacement property. So I have a client who sold the property. He's got $1 million capital gain. It's going to cost him $300,000 if he has to pay the taxes. Well, we ultimately came to, after looking at what was available in this market where he wanted to be, we ultimately came to the conclusion that he was better off paying the taxes than he was buying a property that he wasn't going to get a really good rate of return on, and was going to be a management problem for him because he didn't want to have, big management problems.
If you're paying too much in taxes and you want to recession-proof your investment portfolio while also avoiding those common pitfalls that many investors and syndicators fall into, you should attend Think Multifamily's annual Fire Summit Conference, November 11th and 12th. You can save $100 by using promo code Whitney100 when you go to thinkmultifamily.com/fire. Again, that's promo code Whitney100 to save $100.
Our guests are Alex Shandrovsky and Michael Brady. Thank you both for being on the show today, guys.
Pleasure.
Yeah, thanks for having us.
I know all the listeners, if you are in the syndication business, I know this is a topic and question that I get often, and that I've had to deal personally in our own business as well, is how do we do a 1031 exchange into a syndication? And there's, it seems so complex in the beginning and what that should look like. And I know you as the listener also have questions about how to do this properly. And these guys are experts. They are the experts on 1031 exchange. So, but a little about them before we get started. They both represent Madison 1031, a national qualified intermediary for tax-deferred exchanges pursuant to Internal Revenue Code 1031. Alex is a Silicon Valley seasoned entrepreneur. Starting with a $3,000 loan, he built a multi-million-dollar catering business serving leading tech companies, including Google, Airbnb, and Facebook. As business director for Madison 1031, he provides clients with expert, lawyer, and CPA-approved 1031 exchanges. Michael is Executive Vice President at Madison 1031 and is a certified exchange specialist and attorney. He has over 25 years of experience representing clients in commercial and residential real estate transactions, as well as a wide variety of business transactions and commercial litigation matters, and has acted as general counsel to the title insurance company. So, guys, thank you all again for your time today, but get us started a little bit about, maybe just briefly. I know two of you at one time. We don't have tons of time to dive into backgrounds, but just briefly tell us a little bit about yourself so we can get into this subject that I know a lot of people are wondering about.
Sure. So Mike and I kind of like the odd couple a little bit. So my background is a small business operator. So essentially I started a small business in Silicon Valley. And one of the things I was always looking for is how to be able to scale my cash flow, right? And I learned much more about real estate and real estate services, which brought me to Madison 1031. But I look at it from that small business operator who's looking and be able to create the most effective investment possible. Mike, share a little bit about yourself.
Yeah, sure. So I'm an attorney, as you heard, predominantly in business and real estate. Got involved in 1031 exchanges in 2005, specifically or exclusively as a qualified intermediary. And during that time, I've helped investors defer, I'd say, probably about $1 billion in taxes and doing tax-deferred exchanges and structuring transactions, specifically with syndicators and some ideas we have for syndication.
Awesome. Well, I mean, that's a big deal to defer a billion. Did you say $1 billion?
Yeah.
$1 billion in taxes. I mean, what a great avenue here that we need to know about, right? I mean, you're in the real estate business. You need to know about a 1031 exchange, and specifically in the syndication business, you need to know how to help that investor who has that property they're selling and they want to invest. Like I want to be confident in this to be able to say, yes, we can do this, or no, we can't. Or if we do, then this is how we need to move forward. And so, if you all could just, elaborate or get us started in this process, I'd love to be able to speak to the operator that's listening right now that's saying, I don't know if I can take 1031 money into my syndication. And so maybe, you all could get us started in that, and let's walk through that process.
So let's just take a second and first think about the motivation of the 1031, the individuals who's actually doing the 1031 exchange, right? What's the mindset of the 1031 investor? And then we'll bring it into the syndicator. So essentially, an example I love to use is the IRS is kind of like the Uncle Sam. So he's always that strange uncle who invests with you at every single investment that you make. And when you're ready to actually sell your investment, and there's been capped appreciation, he's coming to you and saying, look, we did so well, it's time for you to give me a percentage of that appreciation, right? Now, but he says, wait a second, you've done so well in the market that I really want you to keep your money in the market. What I'm going to do is I'm going to give you this 1031 exchange vehicle, which is going to allow you to fully reinvest all the proceeds from the sale into another into like-kind exchange, into another like-kind investment property. Now, there's a lot of stipulations and limitations around that, but the motivator behind an individual doing 1031 exchanges, first of all, he's an individual who is looking to reinvest all the proceeds of his sale into the market. He's not looking to just cash out. Two is usually those individuals are looking for a long-term play, right? Some of the individuals that we interact with are going to continue doing exchanges until the point of death, right? Where it's going to allow the stepped-up basis for their inheritors. So we're looking for somebody who's really long-term thinking, a seasoned investor, and really is ready to be able to play long-term in the market. And the government is working alongside him to move the market forward. Now, Mike, could you share a little bit some of the challenges of a syndicator when he's looking at bringing a 1031 investor inside of his syndicate?
Yeah, absolutely. So let me just kind of support what you just said. These are essentially 1031 exchange is a term-free, interest-free loan from various levels of government. And we're talking about the federal government as well as the various states and some cities that actually impose taxes on capital gain that allow you to go out and buy bigger and hopefully more profitable property. So with syndicates in particular, there's some challenges. So the way I look at this is two ways. So you have syndicators who are looking for 1031 investors. Okay, that's one set of challenges. Bringing 1031 money into a syndication as well as the flip side of that, when the syndicated deal is ready to be turned over, is going to be sold to a third party, how do we get our syndicated investors out and allow them to do 1031 exchanges? Okay, so there are two different challenges. It's kind of two sides of the same problem. And it all stems from the fact that essentially the taxpayer who sells the relinquished property, that's the property that they're going to defer the taxes on, has to be the same investor that buys the replacement property, which is the property they'll be investing their capital gain in. And so then we're talking about taxpayers. And so what happens with syndicated deals is predominantly they are set up these days in limited liability companies. They could be limited partnerships as well, that typically are going to be viewed as a partnership for tax purposes. Okay, and that means the partnership is actually going to be the entity or the taxpayer that owns the property. And we can certainly have an LLC or a limited partnership sell a piece of property and go buy a piece of replacement property in that same structure, and that's fine. We can do that all day long. It's the same taxpayer on both sides of the coin. It becomes more problematic, though, where we have an individual who is selling a property and wants to invest in a syndicated deal that's owned by a partnership. And vice versa, if we have a syndicated deal and a partnership that is going to now sell, and we have individuals who want to go off and buy in their separate, in their own names or in, different entities. So that's the problem. And that's really the crux of what the issue is. It's a very, very complicated issue. It's a tough one to get around. Essentially, what we have to do is we have to allow for the same investor on both sides of the exchange. So this can be done two ways. Typically, for the investment into a syndication with the 1031 investor, we would have the investor join in the property, not as a member of the ownership entity, the limited liability company or the partnership. We would bring them in as a tenant in common. So they would have a separate deeded interest in the project along with the syndicated entity. Okay. And there's some formalities we have to respect in that relationship. This is not a great, honestly, not a great arrangement for a syndicator where you would have some preferred returns, some waterfalls and some bumps for the syndicator. But initially, we want to bring them in as a tenant in common, and you could have these co-owners. We should look at, I'm going to throw out some legal lingo here, so forgive me. We want to look at Revenue Procedure 2002-22, which gives us some guidance on how to be set up as a tenant in common versus a partnership. And, they can operate that way for a period of time. And at some point down the road, and that's not necessarily a magic number, they can then have the tenant in common investor contribute their ownership to the syndicated entity and become part of the family, essentially. Okay, so that's one way for bringing in syndicated money. Likewise, on the exit from the syndicate, we also have to kind of bring ourselves out of the partnership model into individual ownership. So we would do something, typically it's called a drop and swap, where we would basically have the syndicate deed out individual interest in the property to the taxpayers, to the syndicated, the investors, so that they could then go on their separate ways and go buy replacement property on their own. There's some timing consequences to that. We want to do this in advance. We don't want to do this at the last minute. It may make sense, a couple of years before the target of selling the property to restructure the entity into tenant in common. That's some things to look at. This is something that you really need to work with tax and legal advisors in advance and plan to make sure that you're going to be in compliance or have your transaction meet scrutiny if the IRS or the state governments were to audit.
Thank you for being with us again today. I hope you have liked and subscribed to the show. Please tell your friends about the Real Estate Syndication Show, and I hope that you are learning and growing. Don't forget to go to lifebridgecapital.com where you can start investing today.